Hey traders and investors, this is the August 12th weekly report on the market. It's going to go from a big picture analysis of cycles and where we stand in terms of risk and seasonality wise, and then jump into the fine details and the short-term sell signals and patterns unfolding for some pretty big moves over the next several weeks and months going into the end of the year. So long story short, if you take a look at this symbol at the top, it's RSP plus IWM plus IWC. That is equal weighted SP 500, small cap stocks and micro caps. This is the majority of stocks, thousands of stocks there. What we want to look at is this overall pattern that we've seen in this market, which is a stage 3 topping phase where the market had a huge run up, blow off move, broke to the downside. Now it's forming this complacency move, which is people think the market, the majority of people who aren't savvy like we are in most cases, are expecting this market to keep going higher. But it is about to go off a cliff into a huge sell-off phase. And this pattern is known as a stage 3 topping phase, which we can see from our infographic here. There are 4 stages to the market. Stan Weinstein, in his book, How to Profit from Bulls and Bears, explained this. And more or less, we are in this topping phase where the market had a huge run up. Most small cap stocks topped out in 2021, February, March. And really now we're in this complacency, this sideways pause before we go off a cliff into a financial reset. This will be like a 2000 tech bubble burst. It'll be like a 2008 financial crisis. These are big financial resets, and there's always a different reason for why each one happens, but it's just the way the markets move. Now, we do have a bunch of things unfolding in terms of the market cycles. We have gold hitting and testing near all-time highs. Energy stocks have been up near all-time highs. Industrial capital goods stocks have been at all-time highs. All of these are outperforming more or less the stock market. When they do that, we are typically in a topping phase. There's a whole bunch of reasons for it. I won't go into the details right now, but we have all the signs that we are very close from a cycle analysis in terms of sectors coming alive, plus our stage analysis. And on top of that, we're seeing unemployment starting to rise dramatically. We're seeing non-farm payrolls. We're seeing all kinds of things start to happen. And that's this yellow cycle in the background, which is the economic cycle. And so we are starting to see the economy slow, and the stock market typically tops first because investors can see the music coming to an end. So they start to move away from equities and they start to go down. And then we get that confirmed 2 bad GDPs in the US and confirms that we're in a recession. And then the economy goes into a tank and sells off, and everything becomes a new opportunity. It's all a good thing in the grand scheme of things. Now, if we were to just zoom in real quick and take a look at where we are in terms of the risk cycle, a lot of people don't get this. They don't understand basic how the markets move, but we are in this, can't really center it. We are right now at this peak maximum risk. The stock market has or the economy and the stock market, the world in general, has times when it's not very good to invest in anything, like right now almost. And then there's times where things are beat up and it's actually a great opportunity. Typically, when you don't want to do stuff and everything is looking pretty bleak, that is the key opportunity. Right now, people are still thinking the markets are strong, and anybody getting involved right now, putting new money to work, is taking on massive risk and wasting a ton of time. Not only will they draw down in value their accounts, but they're going to have a huge drawdown, wasted years for the market to get back potentially to where it is right now. So, taking one step further, I believe the stock market is very close to a big leg down. Now, seasonality wise, last year the stock market followed this to the T, but I do think we're going to break from it. It doesn't always do exactly this, but if we look at the bottom here, August typically shows we got some initial selling at the beginning, which we've had, and now it starts to rally up a little bit towards the end of August, and then we go into a big sell-off into October. So we'll see how this goes. The charts and what I've been talking about tells us that we could potentially see this market continue to move sideways and higher, very choppy, and grind its way sideways for some time. And if we take a look at the markets, that's what we're going to be able to see. So let's go and take a quick look at the charts. If we go to, say, the SP 500 or the NASDAQ, we have definitely seen short-term wise, we've seen the market generate. The trend has changed with short-term sell signal telling us we're going to have a bout of selling. We had one again about a week ago. It looks like we might get another one this week, another sell signal for this market to sell off. Now, this is a short-term 30-minute chart, regular trading hours only. We don't actually trade this with our strategy here, but it just allows us to know that, hey, there's selling momentum and we should expect some selling. So I wouldn't be surprised if we see another SS this week. And of course, I'll keep you updated as that unfolds. But if we go and we take a look at the charts, you can see here we have the stock market having a nice little bounce last week after a huge sell-off. It's bouncing up, but I do believe we're going to see this market potentially continue to chop around and form what I think will be a bear flag. And then this could go through the rest of August. And then we could see another big move down where we break this low here and eventually break this low, maybe going into October. And I think that the momentum could overall shift and things could get pretty ugly. I don't see us really rallying into the end of the year. I see this more of a big sell-off into the end of the year, which bucks the seasonality trend after the October lows. But what's interesting here is if we take a look at this market and we look, I have cycle analysis on the bottom. Where we're at over the past week is a cluster of specific cycles that generally indicate a intermediate low, where you can see these red bars down here. These are when we're having a cluster of various cycles. They can generate some pretty powerful moves, as we have seen, and we've caught each of these with our strategy. So we'll see if the market comes back to life. For all we know, the market builds up and actually wants to go higher. And of course, if it firms up, we will ride it up just like the last several ones as well. The market climbs a wall of worry. There's a lot of active traders and investors who are worried. The general masses aren't quite as worried as we are because they're oblivious to the cycles at play. But we'll just, again, that's the nice thing about what we do here is we follow price action. We don't try to predict which way it's going. We don't really care. Ideally, we want a huge correction because we can make money from the collapse. Plus, we can reinvest in all kinds of great things after there's been a huge reset and make a lot more, even more money faster. Sell-offs are profitable. Beginnings of new bull markets are very profitable. So that's kind of where we are. And one thing to bring up here, I should mention, is that it's important to look at where we are. If we take a look at our overall strategies, we have this in our members area here. We show that the optimal strategies for various stages. We are in a stage 3 topping phase right here, where it's on the verge of rolling over and starting into a stage 4. The strategies that work best for this are the CGS strategy and also the OTS strategy, which is the options trading. And of course, TTI, which is our technical investor, it does well until the market starts to break down, and then it gives back quite a bit of its recent gains, which we're up about 30+% on the TTI strategy, but it will give back a chunk of that as the market rolls over, and it takes time to get that sell signal. So it's important to always understand what strategy you're using at various stages because the market has 4 different stages, and believe it or not, in most cases, if you have a very simple strategy, it'll only work in one of these stages and you'll struggle 75% of the time, which is what most people do. Our CGS strategy, we automatically evolve and adjust. So it works all the time. That is our focus. And that's why we consistently generate returns with it, which is our CGS strategy, this performance here where we continue to grind higher. Our ban strategy is not in favor right now, which is why I keep bringing this up and tell you that during our trade alerts that I'm not taking the ban trades right now. We're waiting for a new raging bull market where ban can do very well. But right now, we're just letting our markets continue to push up. Performance doing very well. We're up about 14% with the CGS strategy. The stock market has, since this has been updated, collapsed. Most of these gains have been evaporated. So we're definitely able to just consistently pull money out with that strategy. So let's jump into a little bit more of the charts. We are expecting the stock market to gap higher today. We'll see if selling steps in. We're definitely seeing money rotate into the bond market. If we look at TLT, it's had a huge pop and move. It's kind of chopping around, trying to figure out what to do. People anticipating rates eventually coming down, but we're not quite there just yet. If we take a look at some defensive plays, we got XLU, utilities. It's been holding up very well. We talked about this last week where utilities have screamed higher and the stock market, like the SP 500, sold off at the same time. When we have like a 10 or 12% spread, it usually means we're going to see a big market correction. We actually saw this spread before the correction. We talked about it. I said this is a huge red flag, and then the markets crashed a few days in a row and tons of damage was done. So these are some little things that we talk about, and it's nice to know when something big is about to happen so we're prepared. And of course, we've been in cash for a while, letting this market reset itself anyway. Overall, if we go down and we take a look over at gold and silver both slightly higher this morning. Gold very close to breaking to new all-time highs again, which is nothing to be surprised about. We are expecting gold to run up to 2650 or 2750 before it goes into a bigger correction. Silver, definitely more volatile. It's finding a little bit of a bid and a bounce, but again, it is pulling back and struggling a little bit just because it's not a full-on defensive play like gold. It's not quite the same safe haven status. Super volatile, so it shakes people up and creates a lot more fear. And same with the gold miners. We've got this kind of rising channel. Overall, lots of volatility all over the place trying to figure itself out. And this is why I keep leaning towards gold. If you just want to consistently pull money out in this very difficult market condition, just gold is the simple, straight up play if you're in the precious metals space. Getting into silver and miners trying to make a ton of money usually is going to backfire in most cases. They'll underperform and or chop you and shake you out because of this volatility. Again, these are huge swings that happen very quickly. These are 13% swings back and forth. So definitely carry a lot of risk when you can just get in gold and watch it inch and grind its way higher while the world and everything is kind of falling apart. If we take a look over at energy real quick, crude oil up 1%. It got oversold, came down and tested a support trend line from a while back here. It kind of pierced through just like it has in the past. It's having a knee-jerk reaction bounce up. We got this falling trend line. I don't trade anything based on trend lines ever. I'm just drawing it so you can see the coil, the pattern here of it narrowing. It's coiling, building energy. Eventually it's going to break out. I do have a negative bias on oil. I do think we're going to see it back down into the the $50, $40 range. I mentioned this before and shared it, and so many people on YouTube publicly all said $40, that'll never happen. They think it's ridiculous, but just go back. We don't have to go back very far at all to see oil. How many times has oil come down into this 40 or 50 range? It has been there. Every few years it is back down there. It has gone way below. It has gone negative. So 40 is really just a fair value. It doesn't matter what it costs to get it out of the ground. Commodities don't work that way when they trade. They will trade at whatever the market currently demands for it. Could be 40, could be 140. Who knows? It's all about following price and supply and demand through the futures kind of tell us what it is actually worth at any given time. Anyway, that's kind of the view for oil. I do think this is a big bearish pennant and it's pointing to much lower pricing. And it'll just bring us back to where we have been many, many times in the past. And of course, that means we're probably in a recession. Travel has slowed, business sales have slowed, product sales have slowed. You don't need as much petroleum and everything slows down. Other than that, that's about it for this morning. If we take a look at the hot list, we do have IYR, which is the real estate ETF. Of course, a lot of people are getting very nervous about stocks, and they've been moving to gold. They've been moving to what they can easily, which is they're moving to gold, which is a physical asset, and people are moving to IYR, which is a real estate ETF. So people are saying, well, put me into like a physical asset. And IYR, while it's a bunch of companies, it's a trust. Naturally people are like, well, I'll buy into real estate. And so it's moving up as like kind of people seeing it as like out of the stock market. But the reality is when we go into a bear market, the IYR real estate ETF will fall 50, 60 plus %. You don't want to hold it. It is a stock and it will crash with the panic selling in the stock market. But other than that, that's about it for this morning. We'll see how things unfold. Again, real estate, utilities up near the top, and what used to be at the top is down near the bottom. Semiconductors are beat up. Most of the short-term trends here say down, so things are struggling. Semiconductors have a series of bear flags. 1, 2, 3. It is trying to find support here. This was a massive exhaustion gap in technologies in the market. So I do think this could continue to drag up and potentially poke a little bit higher, or at least chop sideways. But I do think at the end of August, we're going to see it kind of fall off a cliff. And where the semiconductor goes is probably where the rest of the market is going to go, kind of like NVIDIA and things like that. Anyways, that's it for now. Talk to you soon. Bye-bye.